All right, today we're going to peel back the curtain on one of the most talked about and honestly, most mysterious numbers in the business world, corporate valuation. How does anyone decide a company is worth $1 billion or $10 billion or even $100 billion?
You know the feeling. You're scrolling through the news and you see some headline about a startup that's suddenly worth a fortune or an old company getting a wild new price tag, and you just have to stop and think.
Right? Is it just pulled out of thin air? Is there some secret formula locked away in a vault somewhere? Well, the good news is it's not some kind of dark art. And over the next few minutes, we're going to break down exactly how the pros figure it out.
At the end of the day, it all boils down to this one core idea. A company's true worth isn't about the hype or the headlines, it's about its fundamentals. We're talking about the cold, hard cash it's expected to make, how fast it can grow, and how risky that whole venture is. I mean, think about it. $1 you might get next year is worth less than $1 in your pocket today. So the real trick is figuring out how to measure all that future cash and calculate what it's worth right here, right now. Okay, so before we dive into all the fancy models and spreadsheets, we need to get clear on what number we're even trying to find. And in the world of valuation, that golden number is called enterprise value.
Think of enterprise value as the real deal sticker price for a company. If you wanted to buy the entire business, the factories, the brand, the patents, the whole shebang, this is the number you'd be looking at. It's the pure value of the business operations, totally separate from how much cash it has sitting in the bank. And the logic here actually makes perfect sense. Let's say you're buying the company. First, you'd have to pay off all the existing shareholders, right? That's step one. Then you'd also have to take on all the company's debt. That's your responsibility now. That's step two. But here's the nice part. Any extra cash the company has just lying around is now yours to keep, so you can subtract that from the purchase price. What's left? That's the enterprise value.
All right, so now we know our target, that enterprise value. The big question is, how do we actually calculate it? Well, it turns out there isn't just one magic bullet. Analysts have a whole toolkit, and they use a few different lenses to get the clearest possible picture of a company's worth. And we're going to zoom in on the three heavy hitters here: the WACC method, the APV method, and the flow to equity method. Now, I know the name sounds super technical, but don't worry. Just think of them as three different roads that all lead to the same destination.
Okay, theory is great, but let's make this concrete. We're going to follow a company, we'll call it Avco, as it tries to figure out if a new project is worth the investment. This is perfect because it'll let us see all three methods in action, right next to each other.
First up, the most popular kid on the block, the WACC method. WACC stands for weighted average cost of capital. I like to call it the blended recipe approach because it literally blends the costs of a company's two main funding sources, money from shareholders and money from lenders, into one single number.
And the process is pretty straightforward. First, you've got to project all the cash the project is going to generate in the future. Second, you calculate that special blended interest rate, the WACC. And third, this is the magic step, you use that rate to discount all that future cash. You're basically shrinking its value to account for time and risk, bringing it all back to what it's worth today.
Now, a really important ingredient in our blended recipe is the corporate tax rate. For Avco, it's 25%. So why on earth does this matter? Well, because the interest a company pays on its debt is tax deductible. This creates something analysts call a tax shield. It's a huge benefit that makes borrowing money cheaper than it looks on paper. And the WACC formula is specifically built to capture this little perk.
Okay, let's get our hands dirty with Fapco's numbers. We start at the top with sales, 60 million. We subtract out costs and expenses. Then we subtract something called depreciation. That leaves us with a really important number, EBIT, or earnings before interest and taxes. For this project, that's a solid $20 million.
From that $20 million, we take out our taxes. But here's the trick. We have to add that depreciation number back in. Why? Because depreciation isn't real cash that left the building. It's just an accounting concept. Once you add it back, you get the true amount of cash the project is spitting out each year. It's free cash flow. And that number is $21 million.
So that was the WACC method, but that's just one tool in the toolkit. Now let's check out the other two lenses. They come at the problem from totally different angles, but as we're about to see, they should still get us to the same place.
Next up is the adjusted present value, or APV method. This one is a two-step dance. First, you pretend the company has zero debt and you value the project on its own. Then, in a totally separate step, you calculate the value of that awesome tax shield we talked about and you add it on top. It's a really clean way to see the value of the business itself versus the value created by how it's financed. And then we have our third method, flow to equity, or FTE.
This one gets right to the point. It basically ignores the total value and asks a very simple question. After you've paid all the bills and paid back the bank, how much cash is actually left for the shareholders? It's the ultimate what's in it for me approach.
Okay, moment of truth. We've got 3 totally different methods, each with its own philosophy. WACC blends everything together. APV does it in 2 clean steps, and FTE just looks at the shareholders' piece of the pie. Do they actually give us the same answer?
And look at that. Bam! They all land on pretty much the exact same number, about $41.7 million. Now this is the key insight. The fact that these different approaches all point to the same value gives an analyst a massive confidence boost. It's a powerful sanity check that says, yep, we're on the right track.
This is really the beauty of it all. It shows that valuation isn't just guesswork. It's a robust framework. The fact that these different logical paths all converge on one answer tells you that the underlying principles are solid.
So, let's wrap this up. What are the big things you need to remember? Number 1, value is all about future cash, pure and simple. Number 2, enterprise value is that true takeover price. Number 3, analysts don't just use one method, they use several to double-check their work. And finally, never underestimate the power of that little tax break on debt. It plays a huge role in the final number.
And that leaves us with one final, kind of tricky question. We've seen all the math and the logic, but since this is all built on predicting the future, is that multi-billion-dollar number you see in the news a cold hard fact? Or is it just the world's most educated guess? Something to chew on.